What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All-America Institutional Research Survey. In this week's episode, we'll be discussing when will the market bottom. On our podcast website, what'snextformarkets.com, you can view a handful of the supporting charts from this study under the show notes of the episode. I'll be speaking with Stephen Gregory, my long-term colleague who heads up the quantitative research effort at Piper Sandler. Hey, Stephen.
Hello, Michael. Glad we're here today to talk about uncertainty given the volatility we saw in equities this week. It's pretty topical. All the major U.S. indices, the S&Ps, down over 3%. That's on top of all the weakness we saw the week before. I think it's a great conversation to have today.
Good to be hanging out with you, Stephen. It's been a busy week, as you said. A lot of volatility. I've been on the road talking with clients. I was in Florida this week. In the middle of the week, plenty to talk about. We figured it'd be a good time to just, in this podcast, talk about the now and the near term. In terms of our outlook at the beginning of the year, we had focused on a couple major things. On balance, we thought the economy would generally be fine this year. Continued bifurcation in some areas, but overall in the aggregates, things are going to be okay. The perception of that has certainly within the markets changed quite a bit. I feel like 8 weeks ago, remember in the beginning of January, we were hearing clients talk about the potential for the Fed to raise rates. And 2 months later, we're hearing many clients, and you hear this in the news, of course, that is a recession around the corner. This has not been the first time the narrative has completely flip-flopped. I remember counting a couple of weeks ago, you and I were talking about this, just looking at the 10-year bond yield as a proxy for the quote unquote narrative. This is like the sixth 180-degree shift in the narrative, i.e. is the economy good or is the economy bad, since the beginning of 2023. And you can mark those 5 other past periods by peaks and troughs in the 10-year, right? If we go back to September of 2024, the Fed was going to cut a whole bunch. And then just like I said 8 weeks ago, the Fed may hike. And now here we are again, pricing in rate cuts, worried about a recession. And just shows you how much myopia has overtaken the investor's psyche. And rightfully so, there's a lot of uncertainty.
Absolutely. So you mentioned that you were on the road this week. So what are institutional clients, the people you met with, what are they talking about? What are they concerned about? How, if at all, has this changed the way they're looking at markets?
There's probably the most uncertainty today than we've seen since 2022. And if we think about what we talked about at the beginning of the year in our outlook, one of the areas where we had, I think, a lot to say and a lot of conviction was pointing to the fact that investors need to acknowledge that the past 2 years of double-digit returns in equities came from somewhat of a rising tide of tightening credit spreads. If we look back in October of 2022, we had really bearish sentiment and the markets were down a lot and credit spreads were fairly wide. And then over the 2 years to follow, 23 and 24, a lot of the fears in the marketplace that created those widespread credit spreads and the big correction in equities, such as the inflation shock, the fear of Fed tightening, and the fear of recession, essentially went away. So at the beginning of the year, one of our key focuses was that, look, you've got really tight credit spreads today. And I guess I think of that as somewhat of a fuel gauge on your car dashboard. And 2 years ago, we had a lot of fuel that could help propel risk appetite and multiples higher, assuming that those risks would be priced out of the market. And that's definitely what has happened. And coming into the year, that fuel gauge essentially was on empty. It reflects the old saying, the market is priced for perfection. And so it changes the risk reward of all financial assets when you have very little risk priced into equities. And so our view on that was that just to look at the backdrop and say, this is a backdrop where you're not necessarily going to want to be adding risk. If anything, we're going to want to be reducing the risks within your portfolio, such as higher beta stocks, lower quality value stocks, other forms of risk, such as smaller cap. And we had really strong views of that as a starting point. And so now we obviously have a issue that the market is pricing in terms of a risk, all the policy uncertainty. And so those areas of the market that do not like a backdrop of increasing risk have really taken it on the chin year to date.
Yeah, absolutely. Credit spreads are something a lot of institutional investors look at. So you're looking at how much you're paying above the risk-free rate. So whether it's investment grade or corporate high yield, how much premium on top of the risk-free rate you're going to pay. So it's a great barometer of risk in the system. And not just for the fixed income markets, they tend to move with multiples. It's not a linear relationship, but that idea that we were at, depending on whether you're looking at corporate, high yield, 20, 30, 40-year lows in spreads, there wasn't much room to go anywhere. That's the foundation for which we came into this year. Like you said, not much risk was priced in. We were priced for perfection.
Yeah, and I think there's two ways people look at credit spreads. One way is looking from that perspective, which in terms of how we would look at it, the more conventional way people look at credit spreads or understand spreads is in terms of whether the economic backdrop is strong or weak. So the other side of it that people often say is, well, look, credit spreads are really tight. That means the economy is great and the economy is fine. And that's often the case. But when everyone agrees and the markets reflect the economy's great and the economy's fine, it also suggests that people are not worried about it. These two things overlap a bit. And it also suggests that if a problem should arise, the reaction to that problem from that starting sentiment point, everything is fine, could be more violent, similar to what we are seeing today and similar to what we saw in the markets in the beginning of 2022, where we also had very, very tight credit spreads. When I think back in time, I think of 2018 as a point where we also had very tight credit spreads right after the US and global economy had reaccelerated from the beginning of 2016 for a couple of years. And then President Trump in his first term cut corporate tax rates. And similarly, back then, there was a lot of enthusiasm. But right there was also the time where spreads ultimately bottomed, market valuations peaked, and obviously new risks came into the market and created a lot of volatility in 2018. So right now, even despite all of this volatility in the US markets and the sell-off in equities, spreads are still very tight. They have not by any means blown out. They've certainly widened, but what's happened year to date doesn't change our view that there's still not much risk priced in. I think part of that is that right now the market's reacting to headlines and fear, not necessarily fundamentals and hard data that often does really widen spreads alongside falling equity markets.
Those are important points. Spreads being tight doesn't necessarily mean things have to be bad. It doesn't mean risk can't work. It's just the spring isn't as compressed. There's not that much elasticity. And I think from a positioning standpoint, can risk work? Yes. But do you want to be out on the tail, owning high vol stocks, owning super high beta, really being out on the tail? Maybe from a trading standpoint could work, but from a longevity standpoint, that's not really where cards are stacked in your favor, which a lot of factor investing is about, just being in the right pool to fish in.
Yeah, and that's why in the beginning of the year, when we were getting a lot of questions about how to position around tariff risk, and this was really early in the year when there was not as much fear as there is today, the answer to that is not simple or not clear. It's not like there's just a few stocks that are going to be negatively impacted by tariffs. Our answer was, we definitely know we want to avoid higher beta, lower quality, riskier areas of the market as a way to hedge or avoid tariff risks, because if they indeed do become a risk for the market, just by the contagion of fear, those are parts of the market that are going to get hit the hardest. We did a podcast a couple of weeks ago, and we talked about why markets fall. And one of the pieces in that study we didn't talk about, but I'll touch on now, is that in every single 10% correction, the worst factor is high beta. And today, while the S&P hasn't fallen 10% to date or from the peak, the worst factor is high beta. So anytime you're worried about anything, you don't necessarily need to figure out the exact stock or sub-industry or industry group. You just generally need to start off with the idea that I want to avoid risk, particularly if that risk becomes systemic like tariffs have today. So that's what we were talking about with clients this week, reiterating that point.
Yeah, you're talking about what you do want to own. And what we saw this week was beta get hit. You saw parts of the high momentum trade get hit. And what you saw work was profitability, dividend yield, which are tied together. You tend to have to be profitable to pay out money. And dividend was one of the best factors over the last 2 weeks because it also has a small valuation component to it. You can be profitable and really expensive, which was some of the tail of the momentum trade that got hit.
Yeah, conversations in the last couple of weeks, the obvious question is, when is the market going to bottom, or what's going to cause the market to bottom? And there's a lot of different things people are pointing to. Anytime markets fall, obviously you have your technicians start highlighting different data, different support levels, different moving averages, different sentiment readings. And the AAII bearish sentiment reading had spiked a couple of weeks ago to one of the highest levels since the lows in 22, the lows in 2020, or the lows in 09. So you had some extreme sentiment readings there, not all of them, but that was certainly an outlier. And then this week, the S&P 500, I think, closed around the 200-day moving average. And other indices, I think, broke them a little bit, but obviously we ended the week on a positive note with the markets rallying on Friday. So there's a lot of data points there. Not too many people are looking at valuation in terms of stopping this market decline, because certainly no measures of valuation are anywhere in the vicinity of cheap or attractive at the index level. And that's another point, kind of corroborates with the credit spread stories that, yeah, markets are down, but spreads haven't widened that much. And while valuations are down, the S&P 500 and many stocks, we're certainly nowhere near the levels of 2022 or any level that would really be like, oh my God, look how cheap things are and how ridiculously priced they are. And so the answer to the question of when markets are going to bottom, while in hindsight, you can look at all those stats, and when there's an extreme negative sentiment readings, yeah, it's usually a good time to take the other side of it. But ultimately, I believe every market decline ends when the catalysts of the decline start to see some relief. So in our podcast a few weeks ago, we talked about why markets fall, and we talked about how you can chalk it up to three things: spikes in interest rates, spikes in unemployment, i.e. recessions. And then the third bucket was, all the various exogenous shocks that have taken place over the years. And right now, I would chalk this market sell-off to more of an exogenous shock. While there's obviously other fears like a growth slowdown and potential for a recession, right now, what seems to be driving the market is a policy uncertainty more than economic data.
Tariffs was definitely the primary headline driver of uncertainty this week, but there was a lot of other conversations underneath the surface, like the recession one and the potential of, are we in for a growth scare? And those two things are very tied together. What are you seeing, because they're at the heart of this resurgence in uncertainty this year?
Yeah, ironically, right when the Fed cut in September of 24, the data started getting better. I don't think it was because the Fed cut necessarily, but I think because what had occurred in the prior 4 to 5 months leading up to that Fed cut was that interest rates declined. And so we saw data improve. Certainly the unemployment rate, which was at 4.3% around September, started coming down into the rest of the year, and other data improved. And so we saw interest rates go back up for 4 months, and the 10-year went from 360 to just above 480 by the time we got to mid-January. So I think one of the reasons we're actually seeing some soft data in the US economy is just the reflexivity to 4 months of sharply higher interest rates. Certainly we saw that in housing in January and February in the data there. And I think that's part of what's causing some of the slowdown in other areas of consumption. There was, of course, there's reason to point to the weather as well. We had snow in a lot of parts of the country that we often don't. And it was certainly, compared to last year, the winter has been colder and we've gotten more snow year on year. So that's part of the story. And then, of course, more recently, there was the big negative hit to the Atlanta Fed's GDP now, coming from what appeared to be all of the pull forward in imports from the expectation that tariffs were coming. And so what's interesting about that, and I think that data sent their GDP now measure down to negative 2.4% at the low. And that chart was going all over Wall Street and being talked about in the media. And as look how bad the economy is right now, how quickly it is. And so part of that, a big part of that was, of course, the trade pull forward from tariffs. But what we now know as of Friday from the folks that build the Atlanta Fed's GDP Now was that a big chunk of that came from gold imports. You've been doing this for a long time here, and this is certainly an unusual data point. And again, it suggests that you always got to dig into the details of these headlines. So recently, the Atlanta Fed posted a tweet on, I think it was LinkedIn, I'm sure they posted it in their news as well on their website, that the massive widening of the trade deficit in January was due to an increase in non-monetary gold imports, which went from 13.2 billion in December to 32.6 billion in January, and that accounted for nearly 60%, 60, of the widening of the goods trade deficit, and therefore accounted for a huge amount of the decline in the Atlanta Fed's GDP Now series. What's interesting is that the Atlanta Fed does not distinguish gold from other imports in their GDP Now, whereas the BEA, the Bureau of Economic Analysis, does. And so if you remove gold from imports and exports, which have created this wild move in the Atlanta Fed's GDP Now number, they're telling us that it contributed to about 2 percentage points of that decline. And so if you adjust out the gold, you currently now have a Atlanta Fed GDP Now number that is a positive 0.4%, i.e. GDP Now is now back in positive territory, which is 2% higher than where it was just a few days ago. So growth scare perhaps is not as bad, it's not as scary as that popular data point suggests.
That's crazy. Over a 2% swing in a GDP measure. Those are extreme moves.
Yeah. And with that GDP Now data, you always have to be careful early on in the quarter. I've heard people talk about it's like if you're watching a baseball game in the second inning and the team's up 4-0, well, that doesn't necessarily tell you much about how the score is going to end in the ninth inning, assuming we don't go into extra innings, which in GDP we don't. So it can be quite volatile early on in the quarter. But given what I said about interest rates, obviously we've had interest rates declining for now several weeks, couple months. Oil prices are down. The stock market's down, of course. But I would imagine we'll start to see some better data coming from interest rates declining at the margin going forward. And that plus this readjusted GDP Now data that I'm sure will get circulated and now better understood, perhaps could take off some of the fear of the growth slowdown. And then, of course, the jobs report on Friday was okay. There was some mixed data. The headline NFP number came in pretty close to consensus, wasn't as bad as people were really fearing. The unemployment rate ticked up a little bit, so maybe that gives the Fed a little more room or data to point to eventually when they feel they want to cut. And I also think Powell provided some confidence in saying on Friday that the economy is fine. People often think these policymakers have some secret data that they know of ahead of the time that the market doesn't know of yet. And while they do have information on the banking system and other areas of the economy that are not necessarily public, Powell doesn't see some big jobs change that we don't know of yet. I think that's why partially the market responded more positively on Friday.
So you talked about the growth scare, interest rates, mentioned tariffs a few times. And I know that's a really tough one because they're on today, off tomorrow, some are off. That is going to be very path dependent on policy. But overall, what are your expectations for uncertainty and the road ahead?
Yeah. So when we look at this market, there's a great data set of policy uncertainty, and you can get it on the internet if you just type in, Google policy. I think it's the website is policyuncertainty.com, and there's a lot of various measures. And what's unique about this market decline compared to other market declines in recent years is that, again, it's happening because of a large amount of uncertainty from a policymaker. It's not happening because CPI is going from 2% to 9% like it did in 2022. It's not happening because unemployment is going up 4 or 5 months in a row, like what caused the growth scare in August of 24. It's not happening because oil is spiking. It's happening because people are confused about what will happen. So it's hard to quantify, But those policy uncertainty measures, I think, do a good job at quantifying them. They look at various newspapers and calculate a quantified measure of uncertainty given the policy outlook. They take a look at other policy measures and where there's uncertainty in forecasts. So right now, of course, that's been spiking, particularly from the trade component of that. And it's done a pretty good job, that metric, at explaining, certainly in the last few weeks, why the market's going down. And this reminds me a bit of the sell-off in 2018 in the fourth quarter, when the market really just puked as Powell continued to have a very hawkish tone, which was certainly something the market thought was wrong, and therefore we had a sell-off. And ultimately, a couple of months later, in late December, this started in October, the market bottomed essentially when Powell pivoted, which, if you look at the Kansas City's Fed policy uncertainty data, not coincidentally peaked around that same bottom in the market. So similar to today, increasing uncertainty is driving markets down. And I think it's fair to say that the market probably won't really find a sustainable bottom and rebound until we see a sustainable peak and decline in current trade uncertainty. So I think that 2018 experience is something people can look at and study. So where do we go from here? I don't think we're going to know uncertainty is going to peak until we really hear it come from the administration. Certainly, you've got different parts of the Trump administration saying different things about different countries' trade and policy. 1 minute, we're going to do these tariffs, and then 3 hours later, we're not going to do it. So that's just creating more uncertainty, if anything else. And I think the market's going to get really frustrated with that. And it's certainly not a positive. So hopefully Trump kicked the can on a lot of the tariffs with Canada and Mexico over the next month. And hopefully between now and then, they provide some closure and we see some deals. And at least we have certainty. I'm not expecting tariffs to go away, but I think the starting point for the market to think about the market bottoming is at least knowing what the road ahead looks like more than we do today, which we have very little evidence on.
So we're a little path dependent on things, but there's a backdrop doesn't necessarily foster risk taking. So let's talk about that a little bit. What are your recommendations for leadership? You saw defense working, staples, utilities, but you also saw strong fundamentals working, companies that are mature, strong operators with strong balance sheets. You saw larger working. What do you think is going to be the positioning leadership as we continue on in the year?
Yeah, I think I want to acknowledge our audience, which may not be institutional investors that are positioning with a relative focus or hedge funds that are positioning with a long short focus, and talk about for those investors that are long only who care also a lot about absolute returns. So this year, there's been some obviously areas of the market, a lot of the defensive areas that have seen positive absolute returns. And the irony here is that when the market's falling sharply, you can see some stocks go up that are very defensive in nature. But when the market finds a bottom, you often see the money taken right back out of those stocks and essentially could become a risk. Having a very defensive position in equities, or think about staples or some utility stocks, can be quite risky in a sense, is that they become a market timing tool. And so at the beginning of the year, again, given the backdrop with credit spreads that you and I talked about earlier, we said that this was a backdrop where you wanted to add a little more quality, a little more stability in your portfolio, and a little less risk compared to wherever you were over the last 2 years when you had that tailwind of rising multiples and tightening credit spreads. So as we sit here today, you've had a big decline in the market. You've had a huge outperformance of low beta and defense. And so if we're thinking about what could make stocks go up from here or what stocks will go up from here, again, a lot of it, because the market is now so correlated, is really going to be a function of whether the market can find a bottom and whether policy fear can find a top. But if we try to go out beyond the near term, because we don't know the answer when that's going to happen, and we're not in the business of market timing in periods of great uncertainty, especially when it's a function of one person making a decision, not data necessarily. I think investors want to think about a couple things. What are some stocks that they really have conviction in on the fundamentals that have perhaps gotten a lot cheaper now? We're seeing their prices go down. I think that's a shopping list you want to start thinking about. And So I think, yeah, that's what we're recommending, I would say, overall. Number two, I would say just reiterate the backdrop, though, is still one where valuations are still high. Credit spreads are still low. There hasn't, if we get some bottom in the market and peak in policy uncertainty, the upside, aside from a relief rally, is still somewhat limited. We do think we'll have positive returns this year in equities. Again, assuming that that's under the assumption that all these tariffs don't go on and the economy doesn't go into recession. And so we're going to have to follow the news on that and react just like everybody else. But the base case here is that we don't think President Trump and his administration is looking to take the stock market down to get interest rates down, because, I think we have to be cognizant that the stock market is now 200% of GDP, and any spillover in the stock market will spill over into the economy, just like it did in a positive way over the last 2 years. It could do that in a negative way. So could there be more downside? Yes. Is the Trump put at these levels? Probably not. It's probably a good amount lower. So I think you want to look for opportunities. Don't try to time the bottom. There's going to be a lot of volatile news, and take a more cautious approach into a year that is perhaps going to have a lot more uncertainty, and it may persist and it may shift as well. And a backdrop that started in the US with very high expectations and very low risk priced in. So stocks with, I think, more visible fundamentals, more stable fundamentals. This is not the time or the macro backdrop to be betting for home runs and betting on risk like it was, or like you were able to do in the past 2 years with this multi-year tailwind of risks getting largely priced out.
This is great, Michael. Thanks so much for taking the time. For our listeners, I think it's helpful to hear us talk through what we're seeing in the marketplace, what we're keeping an eye on.
All right, Stephen. Good talking to you as always. Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.